Imagine owning a slice of a great business, and every few months, without selling a single share, a little cash quietly lands in your account. That is a dividend, and for many investors, it is the most satisfying part of the whole game. Today, you learn exactly what dividends are, how to read them, the one trap that fools beginners, and how reinvesting them turns a trickle into a flood. Let's start with what a dividend actually is. When a company earns a profit, it has a choice. It can plow that money back into growing the business, or it can hand a portion of it directly to the owners, the shareholders. That handout is the dividend. It is your share of the profits, paid usually 4 times a year, simply for holding the stock. You did nothing, you sold nothing, and yet you got paid. That is the quiet appeal. Now, not every company pays one, and that is important. Young, fast-growing companies usually pay nothing because they would rather reinvest every dollar to grow even faster. Think of a hungry tech startup. Mature, stable giants, on the other hand, the kind that sell soda or soap or electricity, often pay generous dividends because they cannot grow explosively anymore, so they reward you with cash instead. Neither is better. They are just different stages of life. So how do you measure a dividend? The key number is the dividend yield. It is simply the annual dividend divided by the share price, written as a percentage. If a stock costs $100 and pays $3 a year, that is a 3% yield. Yield lets you compare the income from very different stocks on a level field, a bit like comparing the interest rates on 2 savings accounts. But here's the first trap, and it catches everyone. A very high yield is not automatically good. Remember, yield is the dividend divided by the price. So if a company's stock price has crashed, its yield can shoot up to a tempting-looking number, not because it got generous, but because it is in trouble. Chasing the highest yield on the screen often means buying a sinking ship. This is sometimes called a yield trap, and a healthy, sustainable dividend usually matters far more than a flashy one. To check if a dividend is safe, glance at the payout ratio. That is the slice of its profit the company pays out as dividends. A company paying out 40 or 50% of its earnings has plenty of cushion and room to keep paying. A company paying out more than it actually earns, a ratio over 100%, is borrowing or draining savings to fund that dividend, and that is a flashing red light. A dividend is only valuable if the company can actually keep paying it. There is even an elite club for reliability. Companies that have raised their dividend every single year for at least 25 years straight are nicknamed the Dividend Aristocrats. Brands, that have lifted their payout through recessions, crashes, and wars. It is not a guarantee of the future, but it is a powerful sign of a durable, shareholder-friendly business. Now the second trap, the conceptual one. A dividend is not free money falling from the sky. On the day it is paid, the company's value drops by exactly that amount because that cash just left its bank account and entered yours. So you do not magically get richer the instant a dividend is paid. You simply moved value from the stock into your pocket. What truly matters is total return, the dividends plus the change in the share price added together. A stock paying you 5% while quietly falling 10% has lost you money, dividend or not. So here is where the real magic lies. Dividend reinvestment. Instead of spending those quarterly payments, you automatically use them to buy more shares of the same stock. Those new shares then pay their own dividends, which buy even more shares. It is the snowball from our compounding episode, now self-feeding, with dividends earning dividends. Over decades, reinvested dividends have historically made up a huge slice of the stock market's entire total return. Switching on automatic reinvestment is one of the simplest, most powerful buttons you will ever press. And the honest through line, as always, you do not need to handpick individual dividend stocks to enjoy any of this. A broad index fund already holds hundreds of dividend payers, collects all their dividends for you, and most will reinvest them automatically. You get the whole snowball, the aristocrats included, without the risk of betting on any single company's payout. So look again at that little cash landing in your account for doing nothing. You now know what it is, a share of real profit. You know how to read its yield, how to check its safety with the payout ratio, and the two traps, the seductive yield trap and the myth of free money. And above all, You know the secret. Reinvest it, let the dividends buy more dividends, and let that quiet snowball roll for decades. I'll see you in the next one. Until then, keep it simple and get paid to wait.